The regulatory infrastructure of financial markets in India. Ever wondered what keeps the stock market, banks, and other financial institutions in line? Or who ensures that investor interests are protected? Let's break down the regulatory bodies, their roles, and the framework that keeps India's financial market stable and efficient. First, let's talk about why regulation is essential. Financial markets connect investors, companies, and the government to drive economic growth. However, without regulation, we could see fraudulent activities, insider trading, or market manipulation. Regulations protect investors, maintain transparency, and promote stability. In India, we have a structured regulatory system managed by various bodies, each with its specific role. Now, let's meet these key players. Key regulatory bodies in India. 1. The Reserve Bank of India, RBI. The Reserve Bank of India, or RBI, is India's central bank and has been the primary regulator since 1935. RBI's role extends to controlling inflation, managing currency, and overseeing banking operations. It ensures that banks have enough reserves, maintains currency stability, and regulates interest rates through monetary policy, impacting lending and borrowing in the economy. 2. The Securities and Exchange Board of India, SEBI. Next, we have SEBI, or the Securities and Exchange Board of India. Established in 1992, SEBI regulates stock exchanges, brokers, and other participants in the securities market. SEBI's primary goal is to protect investor interests and promote transparency. It sets rules for initial public offerings, IPOs, prevents insider trading, and investigates fraudulent activities. 3. The Insurance Regulatory and Development Authority of India, IRDAI. Moving on to insurance, IRDAI oversees India's insurance sector. It was established in 1999, focusing on ensuring fair treatment of policyholders and fostering a competitive insurance market. IRDAI establishes rules on solvency, licensing, and premium rates to make the insurance sector transparent and resilient. 4. The Pension Fund Regulatory and Development Authority, PFRDA. For pensions, we have the PFRDA. Established in 2003, it regulates the National Pension System, NPS, and other pension schemes in India. PFRDA's main goal is to promote long-term savings and secure retirement income, especially for the working population in India. Coordination among regulatory bodies. These bodies don't work in isolation. There's an essential layer of coordination among them, particularly in the Financial Stability and Development Council, FSDC. FSDC, chaired by the Finance Minister, helps address issues that require cross-regulatory cooperation. This council reviews financial stability concerns, system-wide risks, and oversees India's macroprudential regulatory framework. How regulations benefit investors and markets. How does this entire framework benefit the average investor or business? For one, regulations provide a level of transparency that builds trust. They also ensure that companies disclose their financials accurately, making it easier for investors to make informed decisions. Market regulations also reduce systemic risk, so if one institution fails, it doesn't lead to a domino effect. Recent regulatory developments and trends. India's regulatory landscape is also evolving. For instance, SEBI has introduced new norms for mutual fund transparency, RBI has adopted digital initiatives, and IRDAI is encouraging tech-enabled insurance. These changes aim to make markets more inclusive, accessible, and resilient. So, that's a wrap on India's regulatory infrastructure. Each regulatory body, from RBI to SEBI to IRDAI and PFRDA, plays a crucial role in maintaining market order and fostering trust. With evolving reforms, the future of India's financial markets looks promising for investors and the economy as a whole. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit the bell icon for more insights on finance and investing. Comment below if you have any questions or topics you'd like us to cover. See you in the next one.